Did you know that your 401k is just like a tic-tac-toe game? The three different columns represent the three different tax buckets, and the three rows represent the three different inflow methods to put money in these buckets, and you got total 9 different options. And you gotta check the right box to win big. Today I'll show you how to maximize your 401k plan by using strategies like the profit sharing plan and the Mega Backdoor Roth strategy. And we'll also discuss the maximum IRS limits for the latest 2025 tax year. Most people overcomplicate this stuff, but I'm gonna make this very simple, visual, and practical. By the end of this, you'll know exactly what to do to maximize every single tax bucket inside your 401k plan. Hi, and welcome to the Money Matters MD Show. I'm your host, Dr. Abhishek Gadre, and I'm a pulmonary and critical care physician, and I absolutely love to talk about personal finance topics and make them easy to understand. So today's topic is the 401k plan. If you are a W-2 employee with a large employer, that is probably the most powerful retirement plan that you will have access to. Now, if you're a 1099 contractor, you're not technically considered an employee and you should have your own solo 401k plan, and I'll have a separate video on that. But I think you should still watch the traditional 401k plan video because the basics are pretty much identical. So let's jump right in. So imagine the 401k plan like a tic-tac-toe game. So you got 3 different columns and 3 different rows. So the 3 columns represent the 3 different tax buckets, which represent the pre-tax bucket, the first column. The second column is the Roth 401k bucket, and the last column is the after-tax bucket. Now, in the rows are the 3 different ways you can put money inside these buckets, which is the first one is the employee contribution, which is via the W-2 payroll. The second row represents the employer contribution, which is usually by an employer match or a profit sharing plan. And the last row is the third and the more rare way of contributing to a 401k plan, which is the employee after-tax benefit, in which the employee can actually put after-tax money in this plan. So the first column you see there is the pre-tax bucket. So this bucket, you put money in and you haven't paid any taxes on it yet. So think of this bucket as a joint account between you and Uncle Sam. Uncle Sam means the IRS. So when you're ready to retire, at that time, you'll pull money out of it, and that's when you'll pay taxes on it. And you really don't know what the future tax rate will be when you retire, but your hope is that you're working right now and you're in a higher tax bracket. By the time you retire, you'll be in a lower tax bracket because your income will be lower, and that's the tax bargain you're trying to make. So the second column you see in the middle is called the Roth 401k bucket. This is the bucket in which you put money after you've already paid taxes on it. And all the money which grows in this bucket will forever remain tax-free in the future. Even when time comes to withdraw this money, there will be no taxes owed in this account. And even when this money gets inherited, your heirs will never pay any tax from the Roth bucket in the future because you've already paid taxes before you put money inside. You do pay your current tax rate based on your current tax bracket, but we are in a historically low tax bracket right now. The maximum tax rate historically was during World War II in around 1944. It was 94%. That was the highest tax bracket. People were paying out of their nose in the top tax bracket during World War II. And guess what? It actually stuck around at around 91% for the next 20 years, and it carried on until like 1960s. The US government is in a massive debt crisis right now, and we've never been in so much debt ever before. And we're actually now in more debt than we were back in the World War II times. And the only way the government can pay this debt back is by increasing taxes, by increasing income taxes on you and me. So there's a very high likelihood that in the future coming decades, the top tax bracket will be much, much higher. So it kind of makes sense to diversify between the different tax buckets. You want to put some money in the pre-tax bucket and some money in the Roth bucket so that in retirement, you'll have options to choose from depending on the current tax rate in that given year. The third column is the last tax bucket, which is the after-tax bucket. Now, most people don't even know that this tax bucket exists, and only up to 22% of employers even provide this option to their employees. But if you have this option, you have unlocked the Mega Backdoor Roth 401k strategy for yourselves. I'll discuss the Mega Backdoor Roth 401k strategy later in this video. Now let's talk about the 3 inflow streams to the 401k plan. The first one is the employee contribution. So this is the most traditional way we know and love. the employee makes contribution to the 401k plan through their W-2 payroll deduction. Now, every year during open enrollment, you will have an option somewhere between December and January for most companies. You log into your employer 401k plan website and you plug in what percent of each paycheck you want to contribute to 401k plan. You can also put in the exact dollar amount you want every paycheck to be deducted. Now you can split the contribution between a pre-tax bucket and a Roth bucket, but by default, if you don't make any changes, by default, the money will go in a pre-tax bucket. Now remember, the more you put in the Roth bucket, the smaller your paycheck gets because you have to pay taxes on your contributions up front for the Roth bucket. You cannot contribute to the after-tax bucket through employee payroll. Now the second inflow stream into your 401k is your employer. And any contribution that your employer makes on your behalf will always end up in the pre-tax bucket because your employer is paying you money directly and you never had any chance at all to pay taxes on it. So the employer can't put money in the Roth and after-tax buckets at all. The first way the employer will contribute to your plan is the employer match. Now traditionally, the employer will match 50% of up to the first 6% of your salary that you will contribute. So let's say your W-2 salary is around $100,000 and you contributed $6,000 in your 401k plan through your payroll deferral, the employer will just throw in $3,000 for free. Now, if you're contributing more than 6%, and that's where your employer caps you at, let's say you put in $10,000, your employer will still just max you out at $3,000, they won't contribute anymore. Now, the second type of employer contribution is called the profit sharing plan. In this plan, the employer will just throw money in regardless of you contributing to your 401k plan or not. So for example, they might just contribute $10,000 or $20,000 or $30,000 just directly into your pre-tax bucket, and it doesn't matter if you contributed at all or not. Usually this is a feature of more higher income earners. Now, the third way the employer can contribute to your 401k plan is via something very rare that most people don't have. It's called a supplemental benefits group. In this particular plan, your employer can redirect some part of your compensation via direct contribution to your 401k plan so that you can contribute up to the IRS maximum limit for that tax year. This is something only few people have access to, and this is usually a feature of high income professionals or executives. So now comes the big daddy. This is the Mega Backdoor Roth 401k strategy. So again, most people will not have access to this strategy because only 22% of employers even offer the after-tax bucket. But folks who have access to it, that's amazing for you guys. So it's a two-step process in which the employee contributes directly their own money. You can't contribute from the paycheck. You have to contribute from your own bank account into the 401k plan, into the after-tax bucket first. And then you roll over the money into the Roth bucket. So it's an in-plan conversion, and there's no tax consequences for doing so. And you also have the option of moving money or rolling over money from the after-tax bucket to a Roth IRA bucket instead of the Roth 401k bucket. It really doesn't matter where you roll the money over into. There are no tax consequences for doing so. There really isn't any upper limit because this is a voluntary employee contribution. So the employee can basically contribute all the way up to the IRS maximum limit as long as their income can support such a contribution. This strategy can unlock potentially tens of thousands of dollars an employee can contribute into a Roth bucket, which will grow tax-free for the rest of your life. At the end of the tax year, you may get a 1099-R form from your employer, depending on their requirements. But again, there's no tax implications for applying this strategy. This is completely tax-free. You know, people say that I don't want to put all my money in a 401k bucket and just, pay taxes on it in retirement and not have access to all the money until I'm 6 years old. But there's not just one box. If you know how to play the 401k Tic-Tac-Toe game, you have 9 different boxes and you can be smart about it. Besides, $1 you put today is about $10 in 30 years from now. So if you're saving $100,000 now, that's $1 million in 30 years from now, which is in your retirement. So it's 10 times more effective to save now than later. Besides, if you have the option to save money in a tax-advantaged account like a pre-tax or a Roth, you will hands down save more money compared to a taxable brokerage account just because of the tax track you will otherwise have. Now let's talk about the 401k maximum limits for 2025. So I want you to pause and screenshot this so that you can use it, so that you don't have to memorize all these numbers. But let's go over the most important ones. I'll keep this updated every single year as the numbers get released. So employees can contribute up to $23,500 via W-2 payroll. And this particular contribution goes up with age. So you get some amount of catch-up contribution depending on your age. The numbers are in the slides. The profit sharing plan, the employer can contribute pretty much as they want, as long as it is less than or equal to 25% of your W-2 payroll. The employee after-tax bucket, again, has no separate cutoff. You can contribute all the way up to the IRS maximum for the entire 401k plan, which is $70,000, as long as you're 49 and under. The limits are higher as you get older. As you can see, the 401k maximum limits are extremely high, and if you can optimize every single tax bucket, you will be just fine contributing that much. So just to summarize, I have 3 take-home points for you guys. Point number 1, contribute up to the employer match. And that's also the step 2 in the 10-step savings ladder. And I have a whole separate the savings ladder video, which tells you a structured plan of where to put your money next. Take-home point number 2, diversify between tax buckets. You don't really know what the future tax rate is going to be. I want you to contribute some in the pre-tax and some in the Roth buckets. And take-home point number 3, for high income earners, there are more complicated and interesting strategies like the Mega Backdoor Roth 401k and the profit sharing plans to really maximize how much money you can put in the 401k plan, which is a lot. So scroll down below and comment if you contribute to your Roth 401k bucket. I want you to say Roth, R-O-T-H, Roth. So we all know you're part of the club. Now, did you know that contributing just enough to get the employer match is a step 2 of the 10-step savings ladder? And I have a whole separate video on the savings ladder, which gives you a structured plan and tells you where to put your money next to best work. Now, if you learned something useful today, please like, share, and subscribe my channel. Thank you so much for watching the Money Matters MD Show. Over and out. The Money Matters MD Show is for educational and entertainment purposes only. This is not financial, legal, tax, or medical advice. The opinions and views presented on this channel do not represent my employers or affiliates in any way.